Silver hit $90, got rejected, and crashed $10 in 2 days straight to $80. That rejection at $90 was not random. It was not bad luck. It was a precise institutional trap executed at a mathematically defined level. Curious and understanding exactly how it worked is the key to understanding what this market does next. But the trap is only half the story, because three things happened this week simultaneously that almost nobody is connecting to each other. The dollar broke above 100. European bond yields are exploding to levels that are breaking government budgets. And the COMEX silver market is running on vapor. Volume down 95% from January, open interest at 20-year lows. Those three things together are not a silver story. They are a global financial stress story. And by the end of this video, you will understand exactly what they mean for where this market goes from here. Excited? Stay in. First, the golden pocket, because it explains the how behind this week's crash. When a market makes a significant move and pulls back, traders use Fibonacci retracement levels to identify where the pullback is likely to stop and reverse. The most powerful of those levels is the 0.618, known as the golden pocket. It represents a 61.8% retracement of the previous move. Silver's last major high was $96, it crashed to 77 cents. The 61.8% retracement of the recovery move from $77 back toward $96 lands precisely at $89 to $90. That is not a coincidence. That is mathematics. And the institutional players knew exactly what that level meant. Here is what makes the golden pocket a trap rather than just a technical level. Every serious trader in the market was watching $89 to $90. As silver climbed back toward that zone, the retail narrative turned bullish. The recovery is real. The war will push it higher. Buy the dip. Every one of those retail buy orders was stacking up at exactly $89 to $90. The institutional shorts could see that order flow building. They waited. They waited until the maximum number of retail longs were committed at that level, and then they sold into every single one of those buy orders. Maximum retail commitment, maximum short entry, maximum transfer from weak hands to strong hands. Every retail buy at $90 became a $10 loss at $80. That is how the game is played at the institutional level. They know the levels, they know the psychology, they use predictable retail behavior as fuel. That is the how. Now the why? And the why is where this week becomes something much larger than a silver crash. The dollar index broke above 100 this week, highest level since January of this year. And the speed of the move matters as much as the level itself. The dollar went from 96 to 100 in approximately 2 weeks. 4 points in 2 weeks on the world's reserve currency is a violent move. When the dollar moves that fast, everything priced in dollars gets repriced simultaneously. Gold, silver, oil, commodities, everything. The dollar is the denominator. When the denominator changes, every fraction changes. Gold did not become less valuable this week. Silver did not become less scarce. The measuring stick got 4% stronger in 2 weeks. That 4% dollar move translated directly into the $10 crash in silver and the $200 decline in gold. Now here is the historical context that matters. Every time the DXY has reached 100 or above in the past year, it has reversed. It hit 100 in January of this year. It reversed. It hit 100 in April last year. It reversed. 100 is the level where the strong dollar begins hurting U.S. exports, compressing corporate earnings, and straining the broader economy. The dollar is currently sitting at its historical ceiling for this cycle. If it reverses from here, the metals move that follows will be sharp. If it does not reverse, if it pushes through to 102 or 103, gold tests $4,800 and silver revisits the low 70s. Both scenarios are live right now. The data will determine which one develops. Now, the piece of this week's story that almost no silver analysis is addressing: European bond yields are exploding. UK 10-year gilt yield has risen nearly 50 basis points in the last 2 weeks. 50 basis points in 2 weeks on a major government bond. The UK economy is flatlining, growth near zero. The government built its entire spending framework around lower borrowing costs. Higher yields blow a hole straight through that budget. Germany is worse. German 10-year bond yield just hit new high territory at 2.95. Germany's manufacturing sector is contracting. Their energy cost structure has been under severe pressure from the ongoing conflict. And yet their bond yields are rising while the economy is weakening. When an economy is contracting and bond yields are rising simultaneously, that is not a growth problem. That is stagflation. Inflation winning while the economy is losing, and central banks cannot fix stagflation. Raise rates to fight inflation. The economy breaks faster. Cut rates to save the economy. Inflation accelerates. There is no clean policy exit from that combination. Stagflation is the single most bullish macro environment for precious metals that exists. Every period of sustained stagflation in modern history has produced major gold and silver rallies. The 1970s, 2008. The setup building right now in European bond markets is the same signal arriving earlier in the cycle than most investors are recognizing. And here is what is driving it. Oil feeds into approximately 45,000 separate products, not just fuel, not just transport, food, manufacturing, utilities, housing, packaging, plastics, pharmaceuticals, fertilizers, clothing. Everything that is made, moved, or heated using oil gets more expensive when oil stays elevated. And here is the inflation dimension most analysis is missing entirely. Oil going up today does not mean consumer prices go up today. The wheat gets transported at higher fuel costs. The flour gets processed with higher energy costs. The bread gets baked with higher gas prices. The bread gets trucked to the store at higher diesel prices. Each step in that chain takes weeks. The inflation from this oil shock has not fully hit consumers yet. What European bond yields are doing right now is the bond market pricing what is coming over the next 3 to 6 months. The bond market is the most sophisticated forward pricing mechanism in global finance. And it is telling you the inflation wave is still building, now inside the COMEX silver market. Because this is where the setup for what comes next is being constructed in real time. In January, volume on silver futures was hitting 370,000 contracts in a single session. This week, volume is barely above 20,000 contracts per session, a 95% decline in volume. The silver futures market has essentially emptied out. Speculators gone, leveraged longs wiped out, liquidity evaporated, open interest is at 20-year lows. The last time COMEX silver open interest was this low, silver was trading at $6 or $7 per ounce. Back then, silver was a forgotten metal. Today, silver has nearly tripled in 15 months, and the open interest is at the same level as when nobody cared about it. The crash did exactly what it was designed to do. Maximum capitulation, maximum fear, maximum retail exit. But here is the contrast that reframes the entire picture. While volume is negligible and open interest is at 20-year lows, registered silver for delivery sits at 15,620 contracts against total open interest of 115,854. And March and April combined show 2,147 contracts standing for physical delivery. That is over 14 million ounces of silver that someone intends to take physical possession of. In a market where speculators have completely evacuated, someone is running towards silver and signing delivery notices for 14 million ounces. That is not panic. That is institutional conviction backed by hundreds of millions of dollars. When volume collapses and open interest hits 20-year lows, what remains in the market is physical delivery demand. The weak hands are completely out. The strong hands are standing for delivery. That exact sequence has preceded every major silver rally in the modern market cycle. Shanghai is telling a completely different story from the Western paper price. Shanghai physical silver is currently trading at approximately $94. Western paper is at $80.58, a $14 gap between the two largest silver markets on Earth. But this week, it is not just the premium that matters. Shanghai silver futures are in backwardation. Backwardation means the front-month contract is priced higher than contracts further out in time. Buyers are willing to pay more for silver delivered immediately than for silver delivered in 3 months. That only happens when near-term physical supply is critically tight. The market is not just paying a premium for physical silver, it is paying urgently. More for metal right now than for metal later. And the SHFE vaults backing that physical market are down to approximately 8 million ounces, a $14 east-west gap. Backwardation signaling near-term physical desperation, vaults at 8 million ounces. That gap closes. It always closes. The question is whether it closes by Shanghai coming down to $80 or COMEX going up to $94. With SHFE in backwardation and vaults at 8 million ounces, the direction of that resolution is not ambiguous. One more piece of context before the 5-condition framework. Silver has nearly tripled in 15 months. Gold has nearly doubled over the same period. The $10 decline from $90 to $80 that felt catastrophic this week barely registers as a visible dip across the full 15-month move. Every previous correction in this bull market has been the setup for the next leg higher. The question is whether the data confirms this correction is another one of those setups. 5 conditions answer that question. At every previous bottom in this bull market, 2 or 3 of these conditions were present. Right now, simultaneously, all 5 are present at the same time. Condition 1. European bond yields exploding while economies are contracting. Stagflation confirmation, the single most bullish macro environment precious metals can operate in. Condition 2. COMEX volume down 95% from January peak. Open interest at 20-year lows. Maximum speculative washout achieved. The weak hands are completely gone. Condition 3. 14 million ounces standing for delivery in a market where everyone else has fled. Institutional conviction moving in the exact opposite direction from retail capitulation. Condition 4. Shanghai silver and backwardation at a $14 premium over Western paper with SHFE vaults at 8 million ounces. The physical market signaling near-term supply desperation while the paper market prints 80.58. Condition 5. DXY at 100, its historical ceiling, with the Fed meeting in 3 days. Any language from Powell acknowledging economic deterioration drops the dollar, and when the dollar drops from 100, the forced selling of this week reverses into forced buying. 5 conditions, all present simultaneously. The setup for a reversal has never been more structurally complete than it is right now. The bear case is real and deserves the same precision. If the dollar does not reverse at 100, if it pushes through to 102 or 103, gold tests $4,800 and silver tests the low 70s. That is a live scenario, not a tail risk. The war is not ending. Force majeure declarations remain active. The dollar has momentum. The $80 level must hold on a daily closing basis. If it fails, $77 is the next structural reference. Below $77, the low 70s come into discussion. COMEX open interest at 20-year lows does not guarantee a bottom. Maximum washout and confirmed bottom are not the same thing. The timing of any reversal is not predictable, only the setup is. The setup is the strongest it has been in this entire cycle. That does not mean the paper price cannot go lower before the physical reality forces the resolution. Size accordingly. Here is what to watch through next week. Watch the DXY at 100. Every session that closes and holds above 100 adds momentum to the dollar move. Every rejection of 100 on a daily close adds evidence the historical ceiling is holding. The direction of the next sustained daily close determines the metal's direction in the short term. Watch the Fed meeting Tuesday. Not for a rate cut. The market price is 99.1% probability of no change. Watch the language specifically. Any acknowledgement of economic deterioration from the war and energy shock, any signal that rate cuts are back on the table, that language alone drops the dollar and reverses the metal's selling. Watch COMEX delivery notices daily. If the 14 million ounces standing for delivery holds through March and April cycles without a significant increase in registered inventory, the physical stress is real and building. COMEX publishes these figures publicly every session. Watch Shanghai backwardation. If the front-month premium over back months persists or widens, near-term physical desperation is deepening. If the futures curve normalizes into contango, the acute supply stress is easing. That curve structure is the most precise near-term physical signal available. Watch European bond yields. UK gilt and German bond yields staying elevated while their economies contract is the leading indicator for the global inflation wave still moving through the supply chain. Each week those yields hold at current levels is another week of inflation confirmation building in the smartest forward pricing market in the world. Here is where the market stands. Silver at 80.58. The golden pocket trap at $89 to $90 executed exactly as the institutional positioning predicted. The dollar broke above 100. Its historical ceiling for this cycle. European bond yields exploding while economies contract. Stagflation confirmation building in real time. COMEX volume down 95% from January. Open interest at 20-year lows. Maximum capitulation achieved. 14 million ounces standing for delivery in an emptied market. Institutional conviction running directly against retail panic. Shanghai and backwardation at a $14 premium with vaults at 8 million ounces. Physical markets signaling near-term supply desperation. 5 conditions, all present simultaneously. At every previous bottom in this bull market, 2 or 3 were present. Today, all 5 are live at the same time. The data has not changed this week, only the price has changed, and price follows data eventually. It always does. Verify every number in this video. COMEX volume and open interest data is publicly available and updated daily. SHFE vault figures are published on the exchange. Fed rate probability tables are live on CME FedWatch. European bond yield data is available on any public financial data terminal. The data is public, the mechanics are understandable, the only requirement is the discipline to read the physical market as clearly as you read the paper price, and to understand that when the two diverge this sharply, one of them is wrong. The $14 gap between Shanghai and New York will close. The only question is which direction. Invest with logic, not hype. Market Crux. Signing off. Market Crux. All data independently verifiable, not financial advice.